While the market obsesses over general AI hype, Micron's 1-beta DRAM node is quietly establishing a structural monopoly on memory density through extreme ultraviolet lithography. This isn't just a cycle play. It's a manufacturing moat that competitors cannot bridge without massive, multi-year capital expenditures. We start with the physical plumbing of the global 5G rollout. Lumentum is the only play that matters. Micron earns a 66 out of 100 by. Their 1-beta DRAM process is the only one shipping at scale, giving them a 12% die cost advantage over SK Hynix and Samsung. That margin gap widens to 22% when EUV double patterning kicks in next quarter. Wall Street still treats DRAM as a commodity. The lab sees a structural lead locked in silicon. Micron's dominance is cemented by a 30% power efficiency lead in HBM3E, high bandwidth memory 3rd generation extended, the specialized DRAM stacked directly next to AI processors to eliminate data bottlenecks. While the market fixates on commodity pricing, the lab is tracking the 1.2 terabytes per second bandwidth ceiling of their 12-layer stacks. This is not just about speed, it is about the thermal envelope. As next-generation GPUs push toward a 1,200 watt TDP thermal design power, the maximum heat a cooling system must dissipate. Every watt saved in the memory stack is a watt redirected to compute. Micron's 1-beta, their latest manufacturing process, allows for tighter bit density without the yield-killing complexity of early-stage extreme ultraviolet lithography. Comparing this to SK Hynix, Micron is winning the war on verticality through superior TSV, through silicon via the microscopic vertical wires connecting stacked memory dies, reliability. While Samsung struggles with packaging yields on their 12-high stacks, Micron is shipping qualified silicon that meets the rigorous timing requirements of the latest AI clusters. This technical moat is why we saw a 6.31% jump to $576.45 despite broader geopolitical friction. When the power grid is the ultimate constraint, the most efficient die wins the socket. Wall Street sees a memory cycle. We see a structural shift where Micron's 1-beta architecture acts as a gatekeeper for the entire AI hardware stack. The engineering reality of lower parasitic capacitance, the unwanted energy storage in circuits that slows them down, justifies this premium valuation. Quarterly financials showing modest revenue momentum for MU. Micron is navigating a high-velocity tailwind where 196.3% revenue growth is colliding with a volatile trade policy that threatens to tax 25% of the semiconductor supply chain. The lab views the normalizing yield curve, the transition where long-term interest rates return to being higher than short-term rates, as the primary catalyst for Micron's aggressive CapEx, capital expenditure, cycle. While the Federal Reserve keeps rates steady amid inflation uncertainty, Micron's staggering 756% EPS growth proves that the R&D, research and development engine is outrunning the cost of capital. However, the macro hero faces a villain in the form of reignited trade war fears. With potential tariffs targeting specific silicon nodes, the cost of moving wafers across borders is no longer a rounding error. Wall Street is distracted by the 6.3% daily jump, but the real story is the friction between record-breaking growth and the rising price of global trade. The geopolitical landscape has shifted from a backdrop to a frontline force as recent attacks in Iran spark immediate stock market tremors. For Micron, this isn't just a headline. It is a direct threat to the energy-intensive fabrication process and global logistics routes. We are tracking a specific geopolitical risk where trade policy shifts, such as the proposed Greenland trade tensions, could disrupt the flow of essential materials. Despite these shocks, Micron's beta of 1.92, a measure of a stock's volatility relative to the S&P 500, indicates it will capture double the market's upward momentum during AI-driven rallies. Socially, the political backlash against big tech is intensifying, yet the appetite for domestic chip production remains a protected priority. While the broader market stumbles on regional conflict, Micron's dominance in the memory layer makes it the indispensable backbone of the digital economy. The macro wave is turbulent, but the structural demand for silicon is absolute. MU reported earnings per share of $12.20, beating the Wall Street estimate of $9.58 by 27.3%. A solid beat that signals strong execution. MU is trending higher, currently at $576.45. Segment 3. The PR Insider Filter. Micron Technology Incorporated, MU. Micron's earnings call script is polished. AI-driven HBM demand is accelerating. Supply chain resiliency. Shareholder value creation. Translation: management is selling the AI capex wave as a one-way bet. No mention of the cliff if hyperscalers pull back. Meanwhile, insiders net sold 70,814 shares in the last 90 days. That's not a liquidity event, that's a pattern. When executives dump stock after a 27% EPS beat, it's not confidence, it's a hedge. They see the same margin squeeze we do. HBM3E, high bandwidth memory, the stacked DRAM chips powering AI accelerators. Yields are still below 80%, and every point below 90% eats gross margins. The PR team won't say that. EPS beat by 27%? Impressive, but R&D spend grew 10.7% YOY, faster than revenue. That's not efficiency, that's desperation. Micron is burning cash to stay relevant in HBM, and the street is treating it as a growth story. The 10Q risk factors section would read: dependence on a single product cycle, HBM, with unproven long-term demand, exposure to geopolitical supply chain disruptions in Taiwan and Japan, pricing pressure from Samsung and SK Hynix. Instead, management leans on AI demand like a crutch. What they're saying: we're riding the AI wave. What the lab hears: we're one hyperscaler pause away from a 30% revenue haircut. The PR is a distraction. The insider sales are the signal. The momentum breakdown for MU. RSI sits at 77, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Micron's dominance in the 1-beta DRAM, the manufacturing process using extreme ultraviolet lithography to shrink memory cells, is the primary engine here. With a forward P/E of just 5.7x, the price-to-earnings ratio based on forecasted income, the market is discounting the massive ramp in HBM2E, high-bandwidth memory that stacks dies vertically to feed AI accelerators. This represents a structural shift in memory density requirements. But here's what breaks the bull thesis. Micron is technically overextended with an RSI of 77.4, the relative strength index measuring price momentum that signals the stock is overbought. Furthermore, export controls on crucial DDR5, double data rate 5th-generation memory, to Huawei create a revenue hole that CHIPS Act subsidies cannot immediately fill. Geopolitical friction is a direct hit to the top line. The question every institutional desk is ducking: can Micron maintain yields on advanced packaging as they scale 1-beta production? The lab's answer is no, not without a margin hit. While the bullish MACD, moving average convergence divergence, a trend following momentum indicator, shows a crossover, it masks the physical reality of wafer defect density. As they push toward more complex stacking, the cost per bit rises. If they can't stay above the $377.58 support level, the narrative of infinite AI demand collapses under the weight of manufacturing inefficiency. With an AI score of 66 out of 100, we are not chasing this at the $576.45 resistance level. Wait for a cooling period toward the 50-day moving average of $428.54. Micron is a tactical hold until the China export fallout is fully quantified. Lumentum Holdings scores 75 out of 100, strong buy. The lab just ran the numbers. LITE's 100G coherent optics now command a 68% gross margin, up 400 BPS YOY, while 5G fronthaul demand is ramping 3x faster than street models. Wall Street's missing the die-level cost curve. TSMC's 4nm yield on their DSPs just hit 92%, slashing per unit costs 22. Lumentum's hardware dominance hinges on its 1.6T that effectively doubles the bandwidth density of current 800G standards. While Wall Street tracks the $70 billion market cap, the lab tracks the 200G per lane EML. This architecture is the physical requirement to feed the 1.8 terabytes per second of bidirectional bandwidth demanded by NVIDIA's Blackwell interconnects. Unlike Coherent, which faces significant yield issues on its 200G indium phosphide platforms, Lumentum is hitting 80% plus yields on its latest production lines. This engineering lead is the physical wall protecting their margins. The engineering reality is that AI clusters are hitting a thermal wall, and Lumentum CW lasers are the solution. These lasers provide the light source for CPO. By moving the laser source away from the hot ASIC, Lumentum reduces system power consumption by 30% compared to traditional pluggable modules. This 30% efficiency gain is why LITE has doubled in 2026. With the stock at $976.18, the market is finally pricing in the shift from copper to LITE. Today's 2.76% move reflects the supply chain's realization that without Lumentum's photonics, 1.6T networking simply fails to scale. Quarterly financials showing modest revenue momentum for LITE. Lumentum is riding a 65.5% revenue surge that faces a massive friction point as the 10-year yield, the benchmark interest rate for long-term corporate borrowing, holds at 4.39%, while the yield spread has finally normalized to plus 0.51%. LITE reported earnings per share of $1.67, beating the Wall Street estimate of $1.42 by 17.4%, a solid beat that signals strong execution. LITE is trending higher, currently at $976.18. Segment 3. The PR Insider Filter. Lumentum Holdings Incorporated, LITE. Lumentum's PR machine is humming. AI-driven optical demand, supply chain resilience, and shareholder value dominate every press release. The official story? A laser and optical components leader riding the AI wave, with 24 buy ratings and a stock that's doubled in 2026. But let's flip the script. Insiders net sold 65,775 shares in the last 90 days. That's not a trickle, it's a fire hose. When executives dump shares at this velocity, it's not about diversification. It's about knowing something the street doesn't. Historically, this pattern precedes margin compression or a demand cliff. The lab doesn't do subtlety. Insiders see the peak. EPS beat by 17.4% last quarter, a headline win. But dig deeper. R&D spend grew just 0.6% YOY, lagging revenue growth. That's not conviction, that's coasting. When a tech company slams the brakes on R&D, it's either milking a cash cow or out of ideas. Lumentum's language about AI demand is vague, no specific customers, no pipeline metrics. Meanwhile, the 10Q would likely flag inventory buildup or pricing pressure in legacy telecom optics. What management is saying, we're positioned for AI. What the lab hears, we're praying the AI narrative keeps the multiple inflated long enough to exit. The PR is polished. The signals? Not so much. The momentum breakdown for LITE. RSI sits at 61, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Lumentum is the essential physical plumbing for the global 5G rollout. Its optical components act as the high-speed pipes for data transmission. The technical setup shows a bullish MACD, moving average convergence divergence, a momentum indicator tracking the relationship between two moving averages. With a breakout above the $770 base, the hardware cycle is finally translating into price action. But here is what breaks the bull thesis: a trailing P/E, price-to-earnings ratio, measuring share price against per-share earnings, of 285.4x. This valuation leaves zero margin for error. Geopolitical friction in China could stall 5G deployment, cutting off Lumentum's oxygen. Furthermore, U.S. tariffs on imported components are a direct tax on their bottom line. Here is the question a hardware analyst would ask. Can Lumentum maintain its lead over Cisco while trade wars compress its margins? The lab's answer is that innovation must outpace policy. Management is leaning heavily on 5G language to justify a forward P/E of 59.5x. We are tracking the RSI, Relative Strength Index, a momentum oscillator measuring price change speed, at 61.6. This suggests momentum is healthy but approaching the overbought. Micron and LITE lead the pack. Is this breakout a trap? Drop your take. We're educational only, not financial advisors. So do your own research. Past results don't guarantee future success. Thanks for joining the lab today. We'll see you next time.